Welcome, everybody, to the Financial MD show. This episode is a little different. Dr. Trevor Smith is not joining us today. He's a super busy guy with a lot of fun, exciting things going on. But today we have the pleasure of hearing firsthand answers to some questions that a lot of you have. A lot of you ask me directly or through social media or comment or whatever. Real estate investing. We see a ton of articles about that from the different bloggers, whether it's White Coat Investor or Position on Fire or any of those wonderful guys. It's a huge topic when it comes to physicians and financial planning. And the reason is physicians are quickly reaching limits on things like 401ks or backdoor Roths or any of those things that we typically do recommend. And then it becomes the question in two parts. Number one, where else can I put my money that's tax advantaged and going to grow and be a good investment? And number two, in addition, or just on its own, the question of where can I generate passive income? That's, again, especially in the FIRE movement of becoming financially independent and retiring early. Passive income is always the question. So I thought a little treat for you guys would be to bring in someone I know well, somebody I trust that could give us some real answers and firsthand experience, and you'll get to peek under the hood, so to speak, and see how is a real estate investment made, and not on the huge syndicated end yet, as far as like Fundrise or some of those things, but let's look at a local real estate investor that's putting together deals, offering to investors. Some of our clients at FinancialMD have looked at, and you'll be able to maybe get some answers. Maybe it creates more questions, but that's okay. That's what we're here for. So again, full disclosure, this is not a financial recommendation or personal advice. We can talk about that individually, but this is purely informational purposes only. But let's jump into it. My guest today is Dave Hall with Achieve Real Estate. How is it going, my man?
Good. Thanks for having me.
Yeah, absolutely. Well, I'm excited because this is something I love to talk about, something I'm involved in, and you and I have had several conversations about it, and we've known each other for 20, 25 years anyway, probably, if we were to really go back. But I've seen you grow, and I've seen you start from scratch and grow, I think, even though you may not recognize it, a pretty legitimate, successful real estate empire. You know, as you look back over the last 7 or 8 years, I'm sure you see that now, but along the journey, it's not necessarily easy to see. But so as opposed to me necessarily, I guess, Dave, tell our listeners who you are, what you do, and kind of a snapshot of your business today.
Yeah. So Dave Hall, based in Lansing, Michigan, born and raised here. And I read a book called Rich Dad, Poor Dad when I was in high school, and it made me decide to go into real estate full time. So this was right around the 2008 crash is when I graduated and wanted to flip houses. Not the best time for flipping. So I bought some properties and renovated them, but couldn't sell them. So I rented them. And that was kind of what I was doing for a while, part-time. And then over a few years, I had accumulated some rental properties and the market was getting stronger. So I decided to get back into flipping and start selling some as well as keeping some. And so pretty much for the last 15 years, that's what I've been doing. I buy properties. I started off using my own money in traditional financing, which moved at a much slower pace. And so I pivoted to using hard money, which is your higher interest loans, more risk to lender, and therefore, the higher payout, but it allows investors to move quickly in and out of flips or to get loans that they might not otherwise be able to get. And then over the last couple of years, I've been using primarily private funding from individuals, sometimes from their IRA, sometimes just from their savings account. And they fund the purchase and the renovations of the properties that I'm doing. And then once they're renovated, I can either refinance and after we have a renter in there and pay the investor off, or I sell it and then pay the investor off with the sale. And again, that caused me to pivot again because now I'm realizing that I can't get to where I want to get to by buying, a duplex here or a single family there. So we did 12 last year just to kind of talk about numbers.
Yeah.
But that is still too slow of a pace. And so I'm pivoting now into apartments and multifamily deals. I'm, toying with some other different commercial assets, but that's kind of where I'm pivoting to since I've, built a bit of a track record using private money to put that money into smaller deals. I'm using some of those same investors now to pivot into bigger deals. So for example, last Friday, we closed on a 15 unit. I was able to raise the down payment from a private local investor that I met here in Lansing. And so we bought the property, we renovate it, the investor gets cash flow each month, and they're a limited partner, so they're not involved in the day-to-day. They just wired their funds at closing. We operate it here with my team and send them their check each month, and it seems to be a win-win relationship. So that's kind of where I started and where I'm at, and then that's kind of where I think that the future of my company is going.
Mm-hmm. Okay. So you said it was Rich Dad Poor Dad that got you into this, and we'll put a link to that in the show notes. And probably most of you have heard of this book. I read it. I think I was in high school when I read it as well. And probably no coincidence that Dave and I are both business owners now. But you decided real estate was the thing. You got into it in 2008. Flips weren't really happening. You got into renting. And so would you say that, the growth of your business has not only been in the number, but in the size of the deals, the properties that you're looking at, investors, the money that you're looking for, all that kind of stuff?
Yeah, I mean, with each deal and each year, I'm getting sharper and more specific in what I'm looking for. I think a lot of people when they jump into flipping, they've watched a few shows, and they think that let's buy a house and gut it down to the studs and put it all back together. And that's great for, social media or for a TV show, but not good for reality. So I actually started doing the big heavy flips like that and quickly found out that you can make as much money doing an easy flip, which is more paint and carpet, in cabinets rather than gutting the whole thing. So I started off doing the heavy lifts, and then now I pass on the heavy lifts just because I can do, there's enough opportunity out there to not have to do such a heavy lift on each project. And in order to do the scale that we're trying to do, we try to stick to lighter flips. But yeah, I mean, we've done it all. And I just am realizing now there's easier ways to do the same thing.
Okay. Can you give us a breakdown of your business today? Maybe some numbers in terms of properties, deal sizes lately, that kind of thing?
Yeah, so we just tipped over $1 million of private funds borrowed from private investors. So that's kind of a milestone. But we have about, let's see, I think 85 rental units that we own in our own portfolio. We have a management company that manages those, as well as some properties for other investors. And then we're licensed agents as well. So we do a fair share of, helping clients buy and sell, as well as invest if they want to buy a rental property or if they want to buy their own flip. Or sell their primary. We help with all of those things as well. So over the last maybe 3 years, I think we've done, maybe $30 million worth of real estate transactions on the brokerage side. And then over the last year, we've probably bought and sold 40 units in and out of our portfolio, because it's constantly, sometimes a really good deal comes up that we'll buy and we don't want to necessarily hold it, but because of circumstances, we have to hold it for a little while. Typically, that means we're buying from a tired landlord who has bad tenants. So we buy always from sellers that have some sort of motivation or a problem we can fix. So if it's a tenant, for example, we buy the property, we help the tenants relocate if necessary, fix the property up, and then once it's cash flowing positively, we can put it back out on the market and sell it. So we're constantly evaluating our portfolio and figuring out, which properties we can get rid of and roll the money into something bigger and better, and which ones we want to hold as kind of long-term generational plan for my family and for our business.
Tell us about how you find these deals. I think everybody wonders, okay, it seems like you're finding profitable things. How do you find that? How has that process evolved over the last 10 years of you when you started to where you are today, of how you identify these and gotten more efficient at that?
Yeah, so that was the tricky part. In 2008, everything was a deal. Everything was a closure, and there was a lot of opportunity. But through the years, I mean, it's kind of difficult. The average person thinks that you start on the MLS, which is, I mean, there's good deals on the MLS. I just bought one, or I'm closing on one in 10 days that I found on the MLS. So there's still good deals. But the MLS is where all the competition is. And so if you can get off the MLS and not buy through agents and try to buy off market or go direct to seller, that's a really good option. So for a while, I was doing what's called wholesaling. And for anyone that's not familiar with that, that is where you market to find some sort of motivation. So typically you buy a list. Maybe it's a landlord who's owned a property in a different state, or maybe it's, I mean, there's all sorts of ambulance chasers. You can send a list to recent divorce couples. You can send letters to recently deceased people, to probate. There's lots of different lists you can mail, but So that wholesaling is you find a motivated seller, you get the property
Mhm.
under contract, and then you sell that property or that contract to someone else. You find the deal, let's say, for 25,000, and then you find an investor that wants to flip that house for 30 and buy it from you for 30,000. So the wholesaler makes that $5,000 in between.
Okay.
And so that works. There's a lot of people doing that as a full-time business, but it's very transactional. So
Mhm.
as soon as you do all the work, you find the deal, you close it, you get paid, and then you got to start over. So
Yeah.
I'm familiar with wholesaling, and we've done it, and we do still do some marketing to direct to sellers.
Yeah.
But we pivoted probably last year, and now we buy from wholesalers instead of being the wholesaler. So we're paying fees
Okay.
out to other people to bring us deals, but because of the volume that we do, we're able to sometimes get first dibs on some of those deals because they know that we can close and we can close quickly. So a lot of my deals come from wholesalers. They'll get a deal under contract, they'll send it to me, I can evaluate it, and then if I think it's a good deal, I'll send it out to my investors list to see if anyone wants to fund it. And then
Hmm.
once I get a commitment from an investor,
Ah,
moving
interesting.
forward with the due diligence process and inspecting it and coming up with our quotes. And if everything works out, we typically can close rather quickly, just a couple weeks after sending it out to our investor list.
So you've kind of established these relationships with wholesalers to be able to find ones you trust, ones you know are good at finding the deals, and that's kind of, in a sense, they're finding the deals for you a lot of the time now.
Yeah. And also intentionally, I established myself as an expert in my market by reading or by leading our local real estate investors group. So
Hmm.
we have a Facebook group, which is about 2,500 members, and then we have a couple monthly meetings that I lead. And so, kind of by being the face of that organization, a lot of new wholesalers and new investors will come, and they don't know where else to pitch a deal or to, who else to partner with. So they come to me, and then I can, kind of get first dibs on some of those deals that way as well.
Okay. Is that investing group open to anyone or the public?
Yeah, it's free. We meet monthly, and there's a Facebook group, which is where I share all the events. But yeah, it's free to join. If anyone's interested in real estate, it's a really good spot to get in and just you can read posts from other people. You can get recommendations for contractors and plumbers and that type of thing,
Okay.
as well as just read through other people's experiences and stories on what's working and what's not.
Yeah, great. Okay. Well, we'll put a link to that if that's all right in the show notes, and people
Yeah,
can follow up
absolutely.
and dig deeper into that if they want to. Where do you feel like, in addition to experience or school of hard knocks, let's say, where have you learned the most and gotten some of your education on doing this and getting better at this?
Yeah, so over the last couple of years, everyone's heard, I think, that your network is your net worth. And
Okay.
so by leading the group, I started to network a lot and get really good relationships. And to be more intentional about that, I joined a couple of national groups over the last couple of years, that we meet quarterly all around the country.
Hmm.
And because we're not necessarily in competition, because we're not in the same market, there's a lot of opportunity to share resources and
Okay.
what's working, what's not working. So I go to these groups, I meet these people, and I can come implement what they're doing, what's working for them in their market here in my market. So that's been beneficial. And so then I joined multiple of those groups, and that's where I'm starting to grow and realize how easy it can be to put a deal together that I thought was once complicated.
Hmm.
For example, the apartment deal I just bought, it seemed really complicated up front, but once I talked to my attorney and my bookkeeper and my accountant, and everyone was on the same page, and we had the team kind of rowing in the right direction,
Hmm.
everything kind of fell into place. And that deal was an off-market deal as well that I got from my networking group. A private individual connected me with the seller, and he was getting ready to sell but hadn't listed yet, so I was able to buy that one, put the money together from an investor from my group, and have it all come together. But so from these national mastermind groups, I think has really accelerated my growth over the last couple of years, which allowed me to go from 40 units 2 years ago to 70 units last year, to by the end
Hmm.
of the year we should be over 100.
So I think this is a good point to point out that someone may look at this individual incident and say, "Oh, you got lucky, good deal. They connected you before they put it on the market, this and that." But you would probably trace it back and say, "I didn't get lucky. I put the work in to get these connections, took the time to build this network, not knowing what it would produce, but knowing it should, and more just a numbers game, I would say, of growing that network and stuff just
Yeah,
happens,
the
right?"
joke is, yeah, it only took me 10 years to be an overnight success,
Yeah,
is
yeah.
kind of how people see. But yeah, I mean, things are definitely rolling quickly now, but just exactly as you said, it took a really long time to get there, lots of trial and error. I remember the first time I was raising money from a guy I worked with, and neither one of us knew what we were doing. Do we call an attorney? Do we call an accountant? Do you just give me the money? Like how does all of this work? And we just kind of fumbled through it. He trusted me, and I trusted the deal, and it worked out really well. And he's funded 5 of my deals since then. But I mean, the first couple were really, really rocky, and now things seem to be going smoother. But it's only because things were so rough in the beginning.
Yeah, that's going to happen. You got to expect that.
Yeah.
I think a lot of our listeners are, being that they're physicians, understand that process, that there's not an overnight success. They go through 4 years of undergrad, 4 years of med school, 3+ years of residency before they start making any decent money. And it's tempting for people to look at doctors and be like, dang, must be nice, how to just start making that. And like, well, it certainly takes a good investment of time on their end and money. Geez. I mean, our average physician has like $250,000 to $300,000 in student loan debt. So
yeah,
everything's an investment, right?
Yeah, absolutely. And it's tempting, I think, to once you find a little bit of that success to try to, I don't know, live up to a certain, standard or level where, the people I think that really build the generational wealth are probably the people that you're talking to, or the people that are being intentional from the beginning about their investments and diversifying and, trying to not get too comfortable in a certain lifestyle too soon without putting, planting some seeds early. I know especially real estate, the houses I bought back in 2008, have gone up in value, some 5 or 6 times what I paid for them. And it wasn't because I was a genius and bought at the right time. It's what everyone says in real estate, is that you don't wait and buy real estate, you buy real estate and wait. Over time, it always works out.
That's true. Yeah. And I think that's great. I've heard that same thing with real estate, with land, with whatever. Always appreciates. And that's exactly a point that our listeners can take too, in terms of one of the things that we find with physicians is they get out of training and they get into practice and they start making the 6 figures, and they want to keep up with the doctors around them that they're not working with and have a decent, nice house and the doctor house and the doctor car and trips and all that stuff. And they may make a decent income now, but it's getting blown on stuff, and they're not doing the smart things with the money that they should. They're not starting to save early. They're not paying off debt. They're not getting into some of these things that long term will make them look successful or do the things that they want to do. But you wouldn't believe how many doctors I've met with that are 50, 55 years old and really have nothing to show for it, because they've gotten this lifestyle. We call it lifestyle creep, where your income goes up and your lifestyle kind of goes up to keep up with it. And as your income goes up a little bit, your lifestyle kind of creeps along with it.
Yeah, exactly. And before you know it, you look up and like you said, you don't have much set aside. And then even if the money you have set aside is substantial, in order to maintain your current lifestyle with the current rate of inflation, most people I think are not saving enough. And which is one reason I love real estate, is that it typically rides the wave of inflation, and you can get you can get your debt essentially eliminated by inflation as long as your interest rate is less than the inflation rate. And so by buying property or aligning your interests with inflation and real estate, you kind of ride that wave, and it can work out really well.
So a lot of novice investors that want to get into real estate are asking the question, should I get into flips or should I get into rentals? I mean, what would you say to somebody?
I get that question sometimes as well. And some of my investors are, high income earners, or, and so I think that there's the appeal of doing a flip because it looks so fun on TV, and it can work out. But
and the numbers say in 6 months I can, get 20%.
Right, exactly. But if you really pencil it out, the stress and the hours involved with doing a flip, if that's not, your main skill set, I think that it probably makes more sense to do investments with either with a partner that's more experienced with flips, or to do rentals, because rentals, they don't produce a ton of income initially, but it's that appreciation where you really see the long-term gains when it comes to real estate. A lot of the high income earners I see that jump into flipping are disappointed. And, if you're making $200 an hour as a doctor, let's say, and then you get into a flip and you make $20,000, but it took you 6 months and it took you, hundreds of hours to put all the pieces together, you're making money, but you're losing money when it comes to your highest and best use. And so if you can double down on, maybe work overtime hours or something, if that's really the case at your higher wage, that's your highest and best use, and then roll that extra money into something else, whether it's, putting it with an experienced operator or just putting 20% down on a rental property and hiring a property manager,
Yeah.
I think that's probably going to keep you more sane and make it easier to scale a portfolio rather than be in the nitty gritty and in the day-to-day operations of running a business on the side.
Yeah, that's good. And that's interesting because the question that I ask in any of our financial planning conversations are goals-based questions. When do you want to achieve this? How much do you want? What's your, long term? And we always think long term. Sure, that makes sense. They know that. When we ask the questions, that this is long-term investment. Yep, got it. The stock market might be 10% a year, give or take. That's great. That'll get us to our goals if we save this much. But then when it comes down to the nitty gritty, I only made this. It took me this much, or this rental I got is only cash flowing this. I'm like, hold on, we said long term, and that's a lot of what it takes is coming back to that conversation of we know in our heads this is long term and it should be, but in our gut, we don't, we want it to be cash flowing, very profitable short term. But as you said, that's not the way that wealth is created, especially not generational wealth and a long-term legacy. Our example, as we got into it a year and a half ago with getting our first quadplex is it profitable right now? Yeah. I mean, we put some stuff into it that we're paying off right now. We're slowly raising the rents that we think is a reasonable rate and that kind of thing. But I'm not looking for it to like pay my personal expenses right now. For me, and we can talk about this a little bit, for our high income earners, I was looking for something that was more tax advantaged investing. Roth IRA, that's nice, but you can only do $6,500 a year there, 401ks, those things. But real estate has so many advantages to it. I say, and I know you would say, talk to me about that when you're talking to somebody and in your experience. I know you're not obviously a CPA or financial planner, but when you talk about some of the tax benefits or other benefits of doing real estate investing, what does that look like to you?
Yeah, so the tax benefits, I have a lot of investors that are using their IRA, a self-directed IRA, to invest in deals. And so that money can continue to grow, tax-free if they lend me out of their IRA and I do a deal and then pay it back into the IRA. So that's one way to get typically above average returns. I can't promise nothing certain, but our investors have definitely seen above average returns on the deals that they've done with us. And then same with larger deals. And typically for high income earners, if you can somehow figure out how to become an active real estate professionals, a lot of them, it's their spouse gets licensed. But I think there's a minimum hour amount that you have to do each year in order to be considered active. But by being active, you can take active losses as well. And so on the larger apartment syndication deals, there's a large amount of depreciation that we can take, which is just a phantom expense against your income. And so if you can be considered active in a partnership for an apartment syndication, there are some really large tax advantages that you can get that can drastically eliminate what you're paying in taxes from your ordinary income.
Yeah, that's huge. In fact, this year, in the last year or two, we've been talking to our clients about bonus depreciation with short-term rentals, and a lot of them want to get into that because they want to get their own lake house, but they don't have time to use it a lot. They wonder if they can make money on it. Sure. But we talked about something called bonus depreciation, which we can get into a little bit here, but we've got some more resources on it. Essentially, as Dave said, if you're an active participant, which for our clients, again, it's usually a spouse, the non-doctor spouse is, in our case, in short-term rentals, they're managing the property. So they're handling any updates, remodel upgrades. They're then handling the marketing, getting people in and out and the turnover, remotely, because it's probably an up north property or something. But that allows them to take that depreciation that they take. And with bonus depreciation in terms of short-term rentals, you can take 60, 70% of the depreciable value of that in the first year against their doctor's salary as well, which is huge. I don't know where else you can find something like that.
Yeah, that is a huge tax advantage. But again, you want to align your interests with what the government is wanting you to do. So they do tax, they give tax incentives to people to do exactly what they want done. And so the tax law is not rules, it's kind of guidance on this is how you can save the most money. In real estate,
that's a good way to look at it.
That they point to say, if you don't want to pay taxes, we need real estate, managed by private individuals. So please buy real estate and we'll give you a tax advantage to do so. So why not take advantage of that?
Yeah, absolutely. So then on that note, solar farms. You want to build solar farms, apparently, is what the government is saying right now.
Yeah, not everything the government says makes sense in the long run, but by all means, I mean, I see people that are making money on those even in the short term. It's just a
Yeah.
matter of riding the wave of politics and the economy and trying to figure out where there's an opportunity. So you
Hmm.
mentioned short-term rentals. I think that 2024, whether we're in a recession or not, I think things are going to probably, and I say this because I've been studying the Orlando market pretty heavily because we want to buy
Right.
some rentals there. And bookings have dropped, I think, 30% in the Orlando market.
Yep.
So if
So
someone
we got to
bought
wait for
last
the
year,
housing prices to come down with that, right?
exactly. Yep. So if someone bought last year a short-term rental based on current income and now there's a drop, there might be some motivation there. So
Yes.
economists are saying that maybe 2025 things will get better. And so that means there may be opportunity in this season to buy from, again, motivated sellers that might have overpaid, or maybe their life changed. Now they don't need the property anymore. So it's just a matter of kind of staying aware of the real
Hmm.
estate market, microeconomics and macroeconomics of what's happening, and then trying to find opportunities with whatever's happening, and anytime you can buy something, whether you overpay or not, I think the market will make that correction for you long term.
Hmm.
But you can align yourself with what's happening and try to take advantage of, or and you're really helping someone else out of their problem. If they
Yeah.
overpaid for a property, or if they need to sell quickly for whatever reason, being able to offer them an opportunity to sell when they need to makes
Hmm.
sense. And then if you can get a discount price for helping them in that area, it can be a win-win situation. And then as the economy continues to ebb and flow, as it continues to go up overall, I think
Hmm.
that that's where real estate is really profitable.
Yeah, it makes sense. When you look back at you've grown in this as you've grown your business, what are one or two things that you would say to yourself when you were getting started that you know now that you wish you knew then?
Probably some of the lessons that I learned that were harder, I probably could have avoided had I been more aware, or even just followed my gut on some things.
Mm,
I had the idea of doing all the work myself in the beginning, and that was a great learning experience, but it was probably something I could have leapfrogged by hiring contractors at the beginning. And yes,
yeah.
you pay more and you make less, but the difference at the time was doing, one flip a year and making, let's say 20,000, compared to doing three flips a year and making 15 each. So I'm making
Hmm.
less with each deal, but as I'm able to scale, I can make
Hmm.
less on each deal and still make more overall.
Yep.
So that was a big lesson learned. And so now I have crews that do all of my work, and I'm not involved. I'm not swinging the hammer, as they say, anymore, which allows me to spend more time networking, and finding better deals. And then the other thing is just the power of networking and aligning yourself with other individuals. So now that I have some private lenders, and that's primarily how I'm able to move much faster than my competition. We're able to get in and out of deals. It just makes everything easier when you're dealing with individuals compared to institutions. Most people think I'll go to a bank, put down 20%, have to wait for an appraisal, have to wait for a bank committee. And
Yep.
the banks, as we saw over the last 6 months, their interest rates shot up from, what was it, 3% to 7%. I was just looking at the average mortgage rate for 2022. This says 3.2. I don't know if it's accurate or not, but compared to
Right.
2023, which is 3 or 7.5, so they doubled. And so if you were solely banking on a mortgage to have your numbers make sense, you might be in trouble. But now that I'm using private money, I'm able to pay higher interest, but because I'm able to move faster and I can avoid some of the appraisals and bank fees and origination fees and other things that go into using an institution, we're gaining a lot of momentum and able to do more deals. And like I said, even if we're making less on each deal because of the volume that we're doing, things are working out. And then as we do deals, more deals tend to flow to us, and we're getting sharper and better at each deal that we do. And so I think had I leveraged other people's time in the beginning and other people's money from the beginning, I think I'd be a lot farther than I am now. But I'm learning those lessons every day.
So can you give our listeners an idea, knowing it's not guaranteed and knowing it's not every deal, what are some numbers someone could expect or that you might be projecting on recent deals?
Yeah, so typically the pitch is that we have three options for investors that partner with us. So they can be in a second position for a smaller loan amount. So for example, let's say we're buying a property for $100,000. we'll raise probably 25,000 for a deal like that. It'll be in second position to a hard money lender that's giving us 90% of the purchase price as well as the renovation funds. So the money from the private investor would cover the down payment, would cover some of the closing costs, as well as some of the holding costs while the project is underway. And for those deals, we typically pay out around 12%. And then if they want to be in first position, we can do those same fix and flip type of deals. So for the $100,000 deal, we would offer 10%. And that we can either offer 8% cash flow each month with 2 extra points paid at the end, or we can just have it all accumulate. We offer both options. Mainly if it's an IRA, it becomes kind of a pain to do the monthly payment thing. We offer both options, but that's to be in first position. So it's a slightly lower interest payment, but it's because there's less risk because you're in first position compared to being in second position.
Gotcha.
Then the third option is our apartment syndication deals, and that's a $50,000 minimum. And that's where we pool people's money together, and then use that as a down payment into a larger asset. And those we get equity positions typically, or a debt position, depending on what the investor wants. So debt position, again, we can offer cash flow or have it accumulate. And those are typically 10 to 12% deals. And then, or for equity, there's typically less cash flow, but a bigger payout at the end, since the equity partner gets to take advantage of some of the appreciation as well as the principal pay down. So the apartment deals are a 2 to 7 year hold. I typically write in an extension option to go longer if necessary. A lot of syndicators got in trouble over the last year as interest rates shot up faster than they ever have, trying to exit a property, and all of a sudden no one wants to buy it because interest rates are high. You're kind of in a bad situation. So we put in the option to extend a couple of years just to try to get take advantage of the market depending on what's happening. But those are the 3 options. So a smaller loan in second position at around 12%, a bigger loan, typically 80 to 150,000 in at 10%, or the apartment syndication model, which is a $50,000 minimum, but those payouts can be, they're projected to be cash flow anywhere between 6 and 10%, and then overall internal rate of return is as high as 15 to 20%.
Great. Yeah, that helps. Any advice you would give to investors looking to be an investor, take that step, not necessarily be active, but to get connected with somebody like you? What advice would you give the investor as they're looking into this?
Probably say there's tons of free resources out there. So, reading Rich Dad Poor Dad kind of sets the pace for understanding the power of passive income. So I would start there. There's a website and a group called The Bigger Pockets, which has a podcast. Yeah. They have forums online. There's all your questions can be answered as far as the different types of real estate investing there. And then I would say get involved. Go to your local real estate meeting. Join. There's some Bigger Pockets webinars that are free. You can get a lot of free information. And then just evaluate your risk threshold and then invest, wherever that lands you. So for some people, that means you want to start small and buy a duplex with 20% down and hire a manager. That's a really good way to start. I have a lot of clients that do that. Other times, just invest in someone else. And I'd be careful with some of the apartment syndicators that are doing larger deals. There's some well-known people that take really high fees when it comes to apartment syndication. So they might buy mediocre deals because they're good at raising money. So if they can raise a lot of money and promise a high return, and it ends up not being as good because they took all their fees up front, they don't really care. So just because the person's well known, I would say to really vet syndication and see what the fees and things are going to be. We don't charge any fees currently on any of our apartment deals. We want a win for us to be a win for our investors. So I would just read the fine print. But those are things that you start to question it and learn more about the more knowledgeable you are. Knowledge is power.
Yeah, that's awesome. Anything else you would add that I didn't ask?
Not that I can think of. I just most of the doctors that I've talked to are hands-on type of people. And I would say that it's good to be hands-on because you want to maintain control of your investment, but at the same time you don't want to hold on so tight that it is taken away from your highest and best use. Like you said earlier, you spent a lot of money and a lot of time to get to where you are and get the income that you have. So don't take a step backwards. I mean, unless you love it and you really want to flip houses for a living or something. But I see so many people spending more of their time on a smaller investment, thinking it's somehow going to be a good, it's going to be better than what they're doing, and it turned out to not be. And so a better baby step, I think, would be to maybe give up some of that control and learn
Yes.
from someone else that's doing it in the beginning. And then once you might figure out that you hate, owning duplexes, or that you
Yeah.
love flipping, or you like, just being a limited partner and sitting back and watching cash flow come in on a syndication. But, I would try to maybe dabble in a bunch of different things or research a lot and figure out what fits your personality best, because everybody's different.
Yes. And that, man, I found as a financial planner, I've come across enough physician do-it-yourselfers that I know right offhand, like, hey, man, this is probably not something you should be doing yourself, but if you're going to stick with it, then I can't help you. Like there's a lot of commonality in personalities with a lot of physicians, not all, but a lot of them are kind of a know-it-all when it comes to a lot of things. And ortho surgeons, I'm talking to you, there's a feeling and a little bit of a experience that because they do know so much about a particular topic, that can tend, some of our weaknesses is that can bleed over into other things. Oh, I'm probably going to be good at real estate and finances too. And no, not the same thing at all. We're not, Dave and I aren't going into our kitchen and fixing our elbow fracture. We're going to go find a specialist for that who's good at that and trained at that. And that's just smart. And it'll cost more for sure. But the end result is going to be better at the end. So we've experienced the same thing here for sure, Dave. I'm sure lawyers and CPAs have in every industry. So what Dave is saying in a nice way, I'm going to say it in a straightforward financial MD way. Guys, don't try to do this yourself. You think you do because you read the articles and you read the books and you watched enough videos or podcasts, but it's not. I've met 1 or 2 doctors who are doing it themselves and doing well because they came from either a construction background or experience like that. But by and large, 99% of you, it may be a good idea to get into this, but not to do it on your own. You don't know what you're doing, and you're going to risk too much, and it's going to cost you too much to get good at this. Not saying you can't, but to do it, I will just say it's not worth your time. So
Yeah, it's comical. The amount of apartment syndicators that I network with that say we got a really good deal and we knew it was good because it was owned by this doctor who didn't know what he was doing, and now
so many of that.
to sell it. Yeah, but I mean, it makes sense. You think you hire a manager and everything's going to go smoothly, but it's the day-to-day stuff that it's what you don't know that comes up. And when you're dealing with larger assets, like you said, I would definitely partner with somebody.
Yeah, doing well in one thing doesn't mean you'll do well in every other thing. So you guys know I love you, and but I'm going to speak truth to you here and just from our own experience. So ask for help. If you have to learn the hard way, go for it, but I don't recommend it. So, well, Dave, how can people get a hold of you if they want to know more or get in on some of these deals?
Oh yeah, so we're putting a website together. I don't think it's live right now, but hopefully it will be next week. TrinityCapital.com is where we are looking for investors, or they can feel free to email me. My email is dave@achievelansing.com.
Okay, fantastic. Well, man, this has been great. I love talking about this stuff. I love hanging out with you and digging into these ideas and goals and just seeing this stuff happen. And it always challenges me to think long term, to settle down a bit, but also to get up and dream bigger as well. So it's a good balance, and I think you're doing great things. So thanks for taking the time to be on and educating us a little bit more.
Yeah, absolutely. Thanks for having me, and I look forward to our future conversation.
Yeah, me too.